When freelancers talk about their tax burden, they often focus entirely on federal taxes, the Schedule C, the self-employment tax, the quarterly estimated payments to the IRS. But for most freelancers, there is a second tax bill sitting right next to the federal one, state income tax. And depending on where you live and where your clients are located, that state tax obligation can be surprisingly complicated. Here is what every freelancer needs to know about state income taxes in 2026. First, the basics. As a self-employed person, you are subject to income tax at both the federal and state level. The self-employment tax, the 15.3% that covers Social Security and Medicare, is a federal tax only. States do not have a parallel SE tax, but states do tax your ordinary income. And as a freelancer, your net profit from Schedule C is ordinary income that flows to your state return, just like it flows to your federal return. Most states calculate state income tax starting from your federal adjusted gross income, then apply their own adjustments, deductions, and rates. So what happens at the federal level? Your Schedule C deductions, your self-employed health insurance deduction, your retirement contributions, often flows through to reduce your state taxable income as well. That is good news. The deductions you work hard to claim on your federal return typically help you at the state level too. Now let's talk about state tax rates in 2026, because there is a wide range. 9 states have no state income tax at all: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you live in one of these states, your income tax exposure is purely federal. No state return for earned income. That is a meaningful financial advantage. On the other end, California has a top marginal rate of 13.3%, which is the highest in the country. New York's top rate is 10.9%. New Jersey's top rate is 10.75%. Minnesota tops out at 9.85%. Oregon at 9.9%. Hawaii at 11%. These are significant numbers. A freelancer earning $100,000 in California, after all federal and state taxes, faces a combined federal plus state income tax burden that can exceed 45% of taxable income in top brackets. Some good news from 2026. 9 states are cutting their income tax rates. North Carolina reduced its flat rate to 3.99%. Ohio moved to a flat 2.75% rate on income above $26,050. Montana lowered its top rate to 5.65%. Indiana, Iowa, and several others have also reduced rates as part of multi-year reduction plans. If you live in one of these states, your 2026 state tax burden is lower than it was in prior years. Now, here is where it gets more complicated for freelancers. Estimated quarterly state tax payments. Just like the IRS requires quarterly estimated tax payments if you expect to owe $1,000 or more in federal taxes, most states have a parallel requirement. State estimated payment thresholds are typically lower. Often $500 in expected state tax liability triggers the requirement. State quarterly due dates usually mirror the federal schedule: April 15th, June 15th, September 15th, and January 15th. But not always. Some states have different due dates or different calculation methods. Most states have their own safe harbor rules as well. The federal safe harbor is 100% of prior year's tax liability or 90% of the current year's tax, whichever is less. Many states have similar provisions, but the specific rules vary. California, for example, has different safe harbor rules than New York. Know your state's specific requirements or work with a CPA who does. Failing to make adequate state estimated payments results in state-level underpayment penalties and interest, on top of whatever federal penalties you may face. Now the issue that many freelancers overlook: multi-state obligations. If you perform work physically in a state different from where you live, you travel to a client's office, you attend an event, and do paid work there, you have an extended engagement in another state. You may have a tax filing obligation in that state. This is called tax nexus. Physical presence is the most common nexus trigger. If you perform services in a state, even temporarily, that state may have a claim on the income earned there. This is most commonly relevant for freelancers who travel for client work, consultants who spend weeks on site at a client's location, and gig workers who pick up jobs in multiple states. For most purely remote freelancers who work from home for out-of-state clients, the general rule is that you pay state income tax where you live and work, not where your clients are located. A California-based freelancer with a New York client does not typically owe New York income tax on that work. But a California freelancer who flies to New York for 3 weeks of on-site consulting may have a New York filing obligation. The rules on this vary significantly by state. Some states are more aggressive than others in taxing non-resident income. New York in particular has historically been aggressive about taxing income earned by non-residents within its borders. If you have worked in multiple states during the year, flag it for your CPA before filing season. The multi-state situation adds complexity and can result in filing obligations you did not anticipate. Here is your practical checklist for state income tax as a freelancer. First, determine which state or states you have a filing obligation in based on where you lived and where you physically worked. Second, calculate your expected state income tax liability and determine if quarterly estimated payments are required. Most states use a threshold of $500 in expected tax liability. Third, understand your state's safe harbor rule to avoid underpayment penalties. Fourth, if you move to a new state during the year, you may need to file a part-year resident return in both states. Fifth, if you are considering relocating, the difference in state income tax rates between states can be a significant financial factor over a freelance career. And if you are living in a no-income tax state, this is one place where your location gives you a real financial advantage over freelancers in high-tax states. That advantage compounds over years of career income. State taxes are the second bill that most freelancers underestimate when budgeting for their tax obligations. Get them right, pay them quarterly, and make sure you know which states have a claim on your income. Subscribe for more tax clarity built specifically for freelancers. See you in the next one.